Welcome back to All Things Money. I'm David Blain, and during today's show, we're trying to demystify a little bit about the Federal Reserve and what their role is, who they are, what their role is. If you missed the first couple segments, please go to the web, www.dlblain.com. That's dlblain.com. And there, after a few days, we usually post archived copies of the show where you can download them and listen to them at your leisure. If you have any questions or comments, feel free to send us an email or give us a call. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. We'd love to hear from you, comments or questions on today's show or a topic that you'd like to see in the future. So as I mentioned today, as I'm recording this, is Election Day. A lot of focus on, political races and what's going on in politics. And from our perspective, we have a vested interest because our politicians control a lot with what goes on in the tax code and investments and things like that. We've covered a lot of those on previous shows, but there's another important thing taking place today. The Federal Reserve is meeting in a 2-day meeting where they're widely expected to adopt what's called the QE2, the Queen Elizabeth II, or quantitative easing 2, where the Fed is expected to announce that they will be buying numerous Treasury securities on the open market in the hope of driving bond yields down and spurring investment in the economy, reducing unemployment, all while not letting inflation get out of control. And so we talked a little bit about the role of the Fed and how they do this. So if they succeed in this, it could help and jolt the economy out of sort of the doldrums. It could help to reduce unemployment. If they overshoot and pumping hundreds of billions of dollars into the economy, it could actually create more bubbles, as we saw in the stock market, as we saw in the housing market. There's a whole other school of economic thought that feels like Alan Greenspan and Ben Bernanke, whose nickname is Helicopter Ben, because he said one time something to the effect that if he had to, he would circle around in a helicopter and drop money out to help solve the problems. And there's that's a euphemism for saying he would inject liquidity into the economy as necessary, but there's a whole other school of thought that feels like this massive liquidity and easy money policies are actually the cause of the bubbles that they are claimed to be fighting. So there's a huge risk that we could see another bubble as a result of this quantitative easing. On one of our previous shows, we talked about a bond bubble. When interest rates are down near zero and we've had a secular decline in rates from 15, 16% in the early 80s down to almost nothing today, that is a secular decline that could possibly be creating a bond bubble. And so if this quantitative easing fails, you've got the possibility of creating a bubble, you've got the possibility of creating inflation, but more importantly, I think a lot of financial markets are run on the sentiment or optimism or pessimism of participants. And what the Fed, one of the real dangers of this is if it doesn't work or if it doesn't work very fast, is they run the risk of making people think that they don't know what they're doing and people losing confidence in the Fed. They will have basically used all their bullets, so to speak, and thus adding to the situation or the perception that the situation is dire. It seems like Ben Bernanke, who's in his second term during the first term during 2008, through the quantitative easing and lowering of interest rates, they largely were able to avoid a major financial collapse. And so 2 years after that near collapse in 2008, here we are still sort of struggling in the economy, and it's the Fed's hope that by pumping more money they can boost the economy back up. According to a New York economist, one thing that Mark Gettler, he says Phase 1, which was in 2008, was to avoid a complete market meltdown and something akin to the Great Depression. Phase 2 begins now, in some ways trickier. Once again, we're in a situation where we have to use policies that we haven't really experimented with. That's Mark Gertler, the New York University economist. And so, because of the unique nature of this crisis and the Keynesian economic policies of pumping liquidity have never really been tried in this exact situation. And so the results are somewhat uncertain. But it's widely anticipated that, or actually I should say that it's already been anticipated by many market participants that the Fed is going to do this. So it's actually possible that just by signaling back in August that they were going to do this, that most of the effect has already taken place. We've seen that interest rates, mortgage rates have been driven down. Just the prospect of the Fed entering the market, rates have been driven down. The stock market has already been driven up. It's been on a nice 2-month run. And so the fact is, maybe when they announce this quantitative easing that everyone already sort of knows is going to happen, this is what happens in markets, is they've been anticipating this, and so it may not have much effect at all. One of the biggest dangers that we want to avoid is if you go back to the Japanese economy the past decade or two, that they have had interest rates near zero for a long time. Their economy has been very stagnant, and everything that the central bank has tried to do to stimulate growth in that economy has just not been working. And so that's one of the big dangers of it. There's the Federal Reserve Board of Governors, and now not everyone is in agreement. In fact, Mr. Thomas Hoenig, who's president of the Kansas City Fed, will probably dissent from the decision. He said in October that such measures could be a very dangerous gamble and risk stoking assets bubbles such as the stock market once again. So there you go. There's a down and dirty overview of the Fed, their very important meeting that's taking place, sort of our take on it, that these are largely untested policies. The mere signaling of quantitative easing probably has already helped to stoke the bubble. And so we don't know if it's really going to have much effect at all once it's announced. We think that the outcome of the election will probably have a little bit more effect. But we'll try to talk about this some more, but we're out of time for today. For All Things Money, I'm David Blain. We hope that you will join us again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.